Hi, this is Steve Gorin. Welcome to our TCLE overview of loss limitations, family office partnership, sale to spousal grantor trusts. Thank you, everybody, for attending. Before we begin, I want to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. We will try to answer these during the webcast, but if a fuller answer is needed or we run out of time, it will be answered later via email. A copy of today's slide deck, as well as other reference materials, are available in the resource widget. These include my first quarter newsletter, the article is the basis for today's webinar, and a newer version of my business structuring materials, which supports a slide regarding the consequences of forgiven Paycheck Protection Program loans. You can also find these materials on our website. We encourage you to download any resources or links you may find useful. You can find additional answers to some common technical issues located in the Help widget at the bottom of your screen. This webinar is CLE accredited in California, Illinois, and Texas, and we welcome our Texas office for 1.5 general hours of credit, and in Missouri for 1.8 general credit. And when I say we welcome our Texas office, it's because they are new. This is my first webinar since we've had our Dallas, Texas office. We award CLE based on attendance for the entire 90 minutes. From time to time, you will be required to click a pop-up screen to reflect continued engagement. The certification icon located at the bottom of the screen will only tell you that you have met our criteria for awarding CLE. It does not include certificate of attendance. Once we have verified your attendance, your certificate will be emailed to you later this afternoon. This webinar is being recorded and will be available within 24 hours. You can access it from our website, www.thompsoncoburn.com. All in attendance will also receive a link to the recording. We value your opinions and appreciate your participation in the course. So I'm on slide 2 now, and I'm going to first start off talking about business loss limitations, which has several layers of rules, and the CARES Act has some temporary loosening of some of the rules for business loss limitations. And I'm going to do that for more than a half an hour. This is going to be probably more time on this than any other topic today. Then we'll talk about family office investment expenses, so how you structure your family office and how you can try to deduct the investment expenses associated with that. And then we'll close with talking about sale to spousal grantor trust, some issues under that in comparison to other tools. So business loss limitations, it's interesting because I even targeted this based on a development that occurred earlier in the year. I was gonna thinking about writing an article on that anyway, and then up our shelter-in-place orders and the horrible consequences to the economy, and so it makes it even more relevant now than it ever was. So first, we will review how deductible business losses can lead to a reduction in or refund of income tax, and how the March 27, 2020 relief for coronavirus pandemic, the CARES Act, upended some aspects of the 2017 tax reform on a temporary basis, just to kind of help us get on our feet after the big blow of all the shutdown that's occurred. Next, we will consider various rules limiting the current deduction of business losses, how a 2020 IRS memo explained the effect of these limits on self-employment tax, and how a 2018 case informs remedies when events in a subsequent year merit a refund of taxes paid. So the bottom line, I'm really just trying to give you a flavor for the whole panoply of rules that affects deducting losses without getting into a terrible amount of detail So the CPAs who might be listening, you probably know almost all of this stuff, and much better than I'm going to be explaining it. But I really am trying to give a big picture to those who are not quite as familiar as some of our CPA friends are. So I'm on slide 4. So talk about net operating loss carrybacks, including how those got limited by the 2017 tax reform and how they got temporarily undone. Then we'll talk about basis limitations for deducting partnership and S corporation losses, and you'll see that actually an S corporation introduces some more optionality into whether you take losses or not. So that's a different take on it than you'll hear in most places. Then we'll talk about what's called the at-risk rules, which are another limitation of loss that are tied with that. And then we'll talk about the passive loss rules, which basically say, okay, you have something that's otherwise deductible. If you don't work in the business enough, then you won't deduction. But we're going to do this all at a very high level just to give you the concepts on these things. And then we're going to get into the strategy behind them. But we're not going to get into all the details. Okay, then beyond that, we're going to talk about how the self-employment tax interacts with these various rules regarding losses. And then we're going to talk about a couple of different doctrines that also relate to getting some tax benefits that are different than what you kind of see every day. Okay, so slide 6, we're going to kind of just start from some fundamentals and why we have this idea of net operating loss carrybacks and what it is, but more fundamental to this is the idea of the tax accounting period. So, every year, usually on the calendar year, December 31st, we report our income deductions and other taxable items, and then we eventually compute the resulting tax for that year. And there's just an important concept. You have to have a beginning and end to measuring your income and measuring the liability that's associated with it. And it's not like you would have one tax return that covers 5 years. You have to have an annual return. But the problem is that that's really arbitrary, because you may have 1 year where maybe in December you might collect income early compared to earlier than you thought, and maybe in December you might be collecting what was in January income. And conversely, maybe you have expenses that you decide to pay in January that may have paid in December that you might otherwise have had paid in January. But you may have other kind of things with your business. You may have a business cycle, and your business cycle may say, okay, some years are up years, some years are down years. So how do you manage this business cycle impact on your taxes? If you have some good years and some bad years, then shouldn't you kind of be able to kind of mush them together and say, okay, my overall taxes should just compare my net over all the years, instead of having to pay a huge amount of tax in the high years and maybe a low amount in the lower years, or no tax in the lower years. So part of the theme to this is we're going to talk about the net operating loss carrybacks and carryforwards, but toward the end, some of those other topics which I was just talking about, this clean out right and equitable recoupment, also they kind of adjust for the fact that you have this taxable year aspect that might not actually be totally fair, but it is practical. So slide 7, so each year must stand on its own, and the only relief from the unevenness for this business income and loss I discussed is the idea that if you have what's called the net operating loss, so your business generates a loss for that year, then the tax laws allow you to carry that forward to future years and offset future income, and they may allow you to carry it back to prior years. to get back the taxes that you paid. And if the business is big enough to be sophisticated, then typically the tax accounting rules will cause you to be on what's called the accrual method, and you have what's called economic performance rules, and those tend to accelerate income and tend to defer deductions. So you tend to have your income front-loaded, particularly on some of the larger businesses. And it used to be more like about $5 million in revenues they were talking about before to make it large, and now it's more like about $25 million. But anyway, this idea that for the bigger businesses or sophisticated businesses that you're going to have an acceleration of income that makes the relief from the loss years all that more important. So net operating loss, again, is a business that a loss that may be carried to another year. The 2017 tax reform prevents carrying back these losses. And it allows the losses to offset only 80% of taxable income of future years. So before 2017, you were allowed to carry back some and carry forward some and offset all of your income with that. And the 2017 tax reform basically said, we're not going to let you do that anymore. You're only going to carry forward. So I really think that the prior law was more fair than this. I think that the 2017 tax reform was unfair in doing this. But who cares about my opinion? That has nothing to do with what Congress does. Okay, slide 9. So the CARES Act authorized, so says, okay, tax reform said you're not going to be able to carry back any losses from 2018 going forward. CARES Act said, well, we're going to undo that. We are going to let you carry back losses from 2018, 2019, and 2020 as much as 5 years, which is really longer than it's been in quite a long time, and to offset as much as 100% of taxable income from the prior years. The idea is that if you have some losses from 2018, 2019, we're going to let you carry those back and get tax refunds, and that will help stimulate your business so you can get those tax refunds. Now, first when I saw this, I was kind of puzzled. Why are they allowing 2018 and 2019 losses to be carried back? After all, the coronavirus stuff didn't start affecting our economy until 2020. But what I realized is, if those losses have to be carried forward, and if the business would have massive losses in 2020, then really those losses from 2018, 2019 might be immaterial compared to the 2020 loss, and they might not, the taxpayer might not really get any significant benefit from that. So I think it's the idea is that with the 2020 losses overwhelming what's going on, that they figured, all right, we'll let people just carry back the 2018 and 19 losses, and then they don't have to worry about keeping track of them going forward, and they can get a refund and help stimulate the economy. Okay, now the big tax benefits, of course, from this will tend not to come for the 2020 losses. You won't even be filing your return for 2020 until the spring of 2021. Whatever loss you incur is not really going to give you a current tax benefit. Now, those businesses that owe tax in 2019 might try to get the IRS to agree with them. Please let me defer the payment for 2019 tax, and then when they wind up getting the 2020 loss, then they could carry it back and then wipe out the 2019 income. So it's been a long time since I've done any net operating loss carry back, prepared any return for that, and back when I was practicing accounting. So I'm really not an expert on the mechanics. I did listen to a webinar on April 9th from a national CPA firm that talked about all the procedures, and I realized that there's a lot of different nuances to using the NOLs, and you really need to get a CPA who's sharp on those issues. So those people who are not CPAs, you should definitely coordinate. And again, I'm just trying to spot these issues for you to help you have a meaningful discussion with a client CPA, for those of you who are not CPAs. Okay, so slide 11 mentions a very interesting case that was just decided in the last couple of months. So this allowed a lender to collect on a pledge of a refund of an NOL carryback refund. So the idea is, just think about this. Taxpayer is expecting a loss in 2020. And taxpayer expects to carry back that loss and get a refund from 2015, 16, 17, 18, 19, from those years. So can you get some kind of a refund anticipation loan? I mean, you hear taxpayers getting all these usually rip-off loans to get their before they get their refund on their 1040s. But in this particular case, going to the bank and say, hey, I'm going to have this big loss. Will you loan me money against that? Now, I don't know who's actually going to be doing loans against that, but there's this unique situation here that created some good precedent for it. So I thought I might just go through that really quickly. So in this particular case, the business was in big time trouble, and it went into bankruptcy. And in fact, bankruptcy was not going to be enough to save the business. It needed another $1 million from the lender just to keep it afloat. Now, that lender was already in trouble with this loan, because that lender had already advanced several $1 million to the debtor. So basically, the debtor went in and said, look, loan me $1 million, and that'll keep me afloat, and then I'll do my best to pay you back everything else that I owe you too. So when we come out, so that when I'm under the bankruptcy protection, that maybe I can keep operating and then pay back more of your existing loan. And so the lender said, okay, I'm going to loan you that $1 million, but I want you to pay me the refund whenever you get it. And then lo and behold, when the taxpayer eventually got the refund, the taxpayer said, "Oh, there's a bunch of ambiguity in the pledge agreement," and what happened was that this was an LLC and a pass-through entity, and so it was actually the individual who got the refund, and it was a business loan, and the individual said, hey, there's some ambiguities in that pledge agreement as to which years of NOLs you're entitled to, and I only want to pay you a few $100,000 out of that $1 million, and I want to keep that money for my other personal uses. And the court basically said, look, yes, I do agree with the lender, with the debtor, that there were some ambiguous provisions in the agreement, but everybody knew at the time that loan was supposed to be paid for with tax refunds, and we're not going to let you get away with having that $1 million tax refund and not using it all to pay back that $1 million loan. So some of the morals of the story are, first of all, that type of loan, that type of pledge may be enforceable. I mean, a court actually did enforce that. And the other thing is that you have to be very careful the way you word the pledge agreement for that. So if you do have any clients who are lenders who want to are willing to do some kind of a loan like that, you really need to read the case and see the mistakes that the lender made and the way that they document the loan. And I call them mistakes because if it were 100% clear, then there would not have been litigation over it. So, ideally, you'd want to avoid the litigation. So, I would definitely suggest reading that if you are going to do some kind of a net operating loss refund anticipation loan. Another interesting part of that case was talking about with joint returns, and again, this is just for the lender, so I'm not going to get into all the nuances. But the court did point out, which is good kind of for estate planning people to know, that when you have joint returns, the tax refund is not really jointly owned, where like both taxpayers have the right to it equally. It's really whoever generated the payment and the liability. So that's another kind of interesting side note on it. All right. So off the subject of refund anticipation loans, and on slide 13, let's get into, well, how does a deductible business law even occur? Well, a C corporation is a silo in that any loss that occurs merely offsets the other income it generates. Whereas the owners of a partnership or an S corporation, which we call a pass-through entity, they will use the losses on their K-1. They will try to use it against their other income. So you can imagine somebody who has a lot of income from a successful business or from a successful job, and they have a little side venture off to a little side venture, and that venture may may generate losses, maybe because they're not putting their all into it the way that they do their main business, and then they'll want to use those losses to offset the other income. And when we had really high tax rates, like in the 70%, 50%, and 70%, even higher than that, people sought to use various tax shelters, and so they would invest in businesses that threw off what we call paper losses. And we're going to kind of get into this idea, but the idea of using losses from other businesses to offset your income, so for pass-throughs, so that's you can refer to that as sheltering your income, and if you invest in these businesses, and they throw off a bunch more losses than you even invested, and you're not even working in the business, then a lot of times that's kind of labeled as tax shelters, which is an evil thing to have. So what you have, this concept of losses without investing cash, is something which is considered to be an evil in our tax system. But we're going to kind of go through to talk about, well, what's good and what's evil here. So how do you generate these losses without investing cash? So sometimes it can be because you borrow money from the bank. So the business borrows money from the bank, spends that money, incurs expenses. They don't have enough income yet because most startup businesses do generate losses to begin with while they're kind of getting on their feet or before they've had a stable revenue stream. And so that's one way that they generate losses. Another is depreciation deductions. So depreciation is intended to reflect the fact that tangible assets wear out over time. Now, when it comes to personal property, like equipment, your computers, whatever, depreciation does really measure real decreases in the value of personal property. But accelerated depreciation which under tax reform is as much as 100% of the cost of your equipment, generates losses or artificially reduced income in early years, and then phantom income in later years. So, for example, you borrow money to buy $100,000 worth of equipment. You can deduct that $100,000 now up front. And then let's suppose you sold that equipment for $20,000 in a few years. Well, you have a $20,000 gain when you sell that equipment, even though you actually wind up losing $80,000 on the equipment. And that's because you got to write off the whole $100,000 up front. And of course, the other thing is that just think about the idea: if you have your equipment and you borrow money to on a loan, maybe you have like a 3-year loan to buy that equipment. So every year you're using your profits, which generates your cash flow, to repay that loan. But in those, in years 2 and 3, when you're repaying the loan and you're using your profits for that, that's kind of like having phantom income, because you have profits and you have to pay tax on those profits. You already blew through your deduction in year 1, so you're paying tax on those profits, and you don't have the income, you don't have the cash to pay the tax on the profit, because that cash is going to repay the loan. So the accelerated depreciation can generate early losses and also phantom income in later years. And then there's also kind of a mismatch. If you write off all of your equipment for a few years, and then lo and behold, we don't have the 100% expensing anymore, so then you may have several years when you don't have any new equipment purchases because of what you originally bought. And then when you do have new equipment purchases, you might not be able to write off right away. So you may have accelerated deductions, followed by a lull without as many deductions, followed by getting even deductions again. So it's all kind of weird what these, how these laws work, and they kind of how they have you have an uneven cash flow, which, as I mentioned, that's what the NOLs are trying to help you out with, is the uneven cash flow. So depreciation, so real estate is even more problematic. So although the building may wear out over time, real estate values often increase due to inflation or growth in the surrounding area. So sometimes it's the land, and the fully depreciated building might be worth more than the original purchase price. So depreciation is an artificial deduction for buildings a lot. And real estate investors particularly, they will use the depreciation deductions to avoid the tax on the net cash flow used to pay down the mortgage. And then when they sell the building, they pay capital gain rates. So they pay low capital gain rates, and they get ordinary income deductions to the ordinary income from the depreciation. And so basically they're just getting taxed on capital gain rates, and not ordinary income at all. That's the way a lot of real estate investors kind of play the game. I talked to somebody in the National Tax Office of one of the large international accounting firms a few years ago, and it wasn't a few years, a couple years ago, and talking about the 1998 deduction, and about it's a 20% of qualified business income that came in with the 2017 tax reform, and we were talking about there's all these things that came in so that real estate people might be able to take some advantage of that deduction. And he told me that the percentage of real estate investors who were really able to take advantage of that was in the single digits, because they're able to wipe out the ordinary income, which is all that deduction goes against, all that 20% deduction from quality of business goes against, and all their income was capital gains, which is not eligible for that. So he said it's just a big reporting headache for him to have to do all the paperwork to do the 20% deduction when it winds up being a really small number, and that when he prepares returns, he has to put together all this paperwork that is required to do that generally, but doesn't necessarily really help the owners as much. So, but anyway, if you can kind of think about it from a political viewpoint, you have all these real estate barons who are paying tax at capital gain rates, and the rest of us poor souls are having to pay ordinary income tax on our wages and our self-employment income. So this, this is why people think of it as tax shelters. And when the CARES Act repealed the prohibition against NOL carrybacks, so when the CARES Act said you can do NOL carrybacks, which is going to help a lot of businesses, the New York Times had an article, which was not on the editorial page. It had an article that said, oh, here's a provision in the CARES Act that benefits real estate tycoons. And that's all they said about it. So they did a real hatchet on it, because here's your ordinary businesses need these NOL carrybacks to help them, and it's very real relief. Anyway, you can see that we have some tax shelters, and people get upset about the tax shelters, but just kind of think about the whole thing. I know I'm getting into some policy arguments here, which I usually try to avoid, but the bottom line is our tax laws provide these artificial incentives to create investment with the hope it will provide jobs. Then you have, people who come along and they get these losses, and they get the benefit. But at the same time, these financial incentives are really nice things for entrepreneurs who are risking their financial security and dedicating themselves to building thriving businesses. So the question is, how do you not throw out the baby with the bathwater? How can you crack down on tax shelters while at the same time allowing legitimate businesses, people who are working full-time, to take advantage of these provisions? So the limits that they have to try to crack down on what we call tax shelters are the basis, at-risk, and passive loss rules. So we've got the basis limitations for shareholders in S corp, and then a partnership, and then we'll compare the C corp loss limitations to those for partnerships and S corps. So when an S corp borrows money from a third party, its owners do not get basis for the borrowing. Basically, I jumped ahead. You can deduct the loss only to the extent that you have basis to absorb that loss. So when an S corp borrows from a third party, its owners do not get basis for the borrowing, even if they provide very strong guarantees to the lenders. The owners get basis for a loan only if the owner is a lender. So what you do is you do what's called a back-to-back loan on slide 21. The owner borrows from the lender and loans that money to the S corp. When the owner loans that money to the S corp, the owner will take back a security interest in that loan, and then will pledge that security interest back to the bank. So the bank essentially is doing a secured loan to the business indirectly through the shareholder. So this allows the shareholder to deduct the loss. So now here's the optionality here. So the owner of a business can choose between doing back-to-back loans to be able to deduct the loss, or just having the loan be taken out by the company. Now, the lender is going to have the personal guarantee of the shareholder anyway in many, many circumstances. So the bank might not even really care much whether it does the back-to-back or directly to the company, because it's going to get the same security interest and it's going to have the same obligations. Okay, so now we're on slide 22. Contrast this to a partnership. When a partnership borrows from a third party, its owners are allocated the liabilities and they get basis for the borrowing. Guarantees by the owners may change how the liabilities are allocated among them, but they don't change whether the liabilities are allocated to the owners as a whole. Now, for S corporation, here's a point. Non-taxable income does provide basis. Now, it doesn't provide what's called AAA, which is a concern for an S corp that used to be a C corporation. And I'm not going to get into those details right now because I'm running over. However, expenses allocable to non-taxable income are not deductible. So there's this Paycheck Protection Program, called PPP loan, which of course has been in the news all over the place. And that loan basically is if you're continuing to pay your employees' wages, then they will actually forgive your loan. And if they forgive your loan, there's a special provision in the CARES Act that says that is not going to be taxable income when they forgive the loan. Now, that for most taxpayers, the fact that that's not taxable income is not really going to be a benefit, because the expenses the expenses associated with that loan forgiveness. So you pay wages, so you get your loan forgiven. Well, you're getting non-taxable income because of those wages you paid. Those wages you paid directly caused you non-taxable income. And so those wages are not going to be deductible to the extent that they result in forgiveness. So there's nothing that directly talks about the PPP loan forgiveness and the expenses getting disallowed. But my materials, you can see I have in there the parentheses new, because since I published my newsletter, between then and now, I went and actually found some case law that has a very compelling analysis that you're not going to be able to deduct the expenses that are associated with the forgiveness. So forget about getting a windfall with that. Okay, slide 24, at-risk rules. So we're past the debt issue, but now you have debt that has created a basis. So you get to take the loss. Well, as risk rules say, well, hold on for a minute. If you are not personally at risk, then we will disallow the loss. Now, there are exceptions in there for non-recourse real estate, etc. I'm not going to go through all those exceptions. I just want to let you know that even when the basis rules will still let you take the deduction potentially, the at-risk rules can knock that out if you're not at risk for the loans that are generating the loss. So that would really be a partnership. Because in S corp, you don't get basis unless you personally have made the loan. Okay, so slide 25. So if a non-grantor trust owns an interest in an S corp or parcel that incurred losses suspended by the basis limitation, and the trust terminates, the suspended losses are lost forever with no tax benefit. You can see my comments on slide 25 about what I think you should do with that. I just wanted to point out that issue that you may lose losses forever. Now, pass the loss rules. So suppose you have losses that are not suspended by the basis of at-risk rules. If you don't work enough in the business, then you will have those losses suspended, and then you can try to take them later. Now, let's think about the strategy behind this. Because the passive loss rules suspending the basis or the passive loss rule suspending the losses might actually be good in some cases. So let's suppose you have a business that has a temporary loss, but every indication is that the business will go gangbusters in future years. And so when the business goes gangbusters in future years, it would be really nice to have losses to offset the high income. Contrast that if you take losses in, for example, the current year, then you may be offsetting income at very low rates. You may also have other deductions that would offset your income, so you don't need the business loss to avoid having any income tax for the year. Now, I think that most taxpayers would rather generate an NOL and get the money back. But there are going to be cases when people will see that if they have the money to get past this and they see that they're going to have high tax years, that they might, instead of going through the NOL regime and worrying about, for example, the 2017 Tax Reform Act limitations, and also worrying about the fact that if you generate an NOL this year, then it might offset and might not be used very well. You'd rather maybe have no loss at all this year, or you might limit the loss. So you may get a lot more benefit by intentionally trying to trigger these loss limitations. And I have a reference back to my materials that talks about this idea. Okay, self-employment tax. There was a chief counsel advice this year that came out and talked about, or that was released this year, that talks about that an individual's net earnings from self-employment are based on the income tax rules. So if you have a suspended passive loss, or you have losses suspended for the at-risk limitations, okay, when those losses are allowed, that's when you can deduct them against your self-employment earnings. So you'd have to have a net loss from self-employment to offset the net earnings from self-employment. But the bottom line is that if that loss gets converted into a net operating loss, the net operating loss is not deductible against the net earnings from self-employment. So again, suspending the losses rather than generating an NOL may help people who are having self-employment losses and self-employment income. Okay, Code Section 1341, claim of right deduction. So if an item was included in gross income in a prior taxable year because the taxpayer had an unrestricted right to the item, a deduction is allowable for the taxable year because it was established after the close of the prior year that you did not actually have an unrestricted right to the income. Then you may be able to carry that back, not carry it back, get a benefit. And there was a recent case in 2019 talked about taxpayer had income and she and her husband filed a joint return. The husband had income. He had actually cheated on his compensation, or at least that was the agreement was he overpaid himself, and she was allowed to get the relief because of that joint return. Equitable recoupment is another thing that kind of like if the statute of limitations runs, then you can, and if the statute of limitations runs and provide a fair result to either the taxpayer or the government, there can be ways to kind of undo the effect of the statute running because of that unfairness. So I'm not going to go into all the details. I've gone way over time on this topic, but we do have recent cases on it. So I hope that this has been helpful to you and made you think a little bit more about the timing of taking losses and maybe taking a step back when taxpayers are having losses and deciding, do they really want to have an NOL this year, or do they want to try to take steps to suspend it? Okay, now we're going on to talk about family office partnerships. We'll talk about family office as a trade or business. My materials cover securities laws issues to some extent. I'm not an expert on that, but there is a particular exception that I have written up there. And then, so we're going to skip over that. We're going to focus on the tax issues, and we're going to talk about family office as a trade or business and whether managing investments constitutes a trade or business. So slide 37, managing one's own investments doesn't constitute a trade or business unless one is a day trader or something like that. Managing another person's investments may constitute a trade or business. But a key thing is that a C corporation can deduct expenses of managing investments. So when you look at whether the investment expenses are a business expense or not, it's hard for an individual to qualify, which includes an individual owner of a pass-through business. It's hard for them to qualify. But for C Corp, to qualify as having business income against which you can offset business expenses. But a C Corp can deduct expenses of managing investments. So C Corps are actually better than individuals and pass-throughs for this limited purpose. So slide 38, if you can somehow, what you want to do is instead of, if you pay a management fee, we've got the disallowed and miscellaneous itemized deductions. You're not allowed to deduct, an individual cannot deduct investment management fees relating to just investments. What would be better is if you can deflect the income from your investments into an entity that pays the expenses and can deduct that. So the idea here is you form a partnership, an investment partnership. So you might have family member, you might have mom and dad and maybe trust for kids, and they all have these various investments. And those different taxpayers come to and form an investment partnership, and they give a profits interest to a C corporation. That C corporation manages the business and incurs the investment management fees. So what happens is when you give the profits interest to the C Corp, the underlying investors, mom and dad and trust for kids, those are their income from the investments is being deflected into the C Corp. It's not that they're going to try to get a deduction. They are going to deflect the income into the C Corp. And then the C Corp will be able to deduct the investment management expenses. So that's the overall general idea. I will tell you that this is really challenging planning. When the C Corp is being the managing partner, the C Corp is really what we call a service partner, somebody who has little to no investment in the whole partnership, and instead they're just providing services and getting paid for it with the profits interest. So several years ago, the IRS promulgated proposed regulations that talked about when you have a service partner, are they really a true partner? Is their payment truly subject to all the entrepreneurial risk, or does it look more like a flat fee with a little bit of variation? Okay, so we'll talk about that in a moment. But kind of the key here to the trader business issue. So there was lender management was a case where one branch of the family managed the investments of the other branch, and that was an ideal fact situation for the taxpayer. It's very difficult to replicate that, but it was a taxpayer win, and you will see that 2 years ago I talked about the case, and so if you're interested in trying to make an LLC be a business of investing, then this will tell you exactly the best way to do it. Now there was another case that got settled that they had this whole thing about the LLC managing the investments, but that LLC, the owners they got audited, and they wound up making substantial income tax payments. So slide 40 kind of goes through the facts of that Hellman case. Where it was a family office, and they had 4 family members who all lived in the same city and were on good terms, and it received performance-based compensation based on the success of the investments it made, and one of the investors had authority over day-to-day decisions, and all the investors were also owners of the management company, so you had identical ownership. So this is kind of like the ideal bad fact scenario. Slide 41 and goes through some relevant factors that were relevant factors. And so I'm not going to go through all those here. You can read them yourself. Slide 42. The tax court asked 9 questions to develop facts about the family office's business activities and investors. And when it was asking these questions, the identity of ownership and selection of the family member to run the family office seemed to be major factors. And the taxpayer wind up capitulating to a large degree. So this was an IRS win. So you really need to, if you're going to try to run things through an LLC and have the owners of the LLC deducting the investment expenses, you really have to be very careful to try to make your facts look a lot more like lender management and not like Hellman. Now, I would rather not do that at all and have a C Corp be my managing partner, because a C Corp does not need to prove that it's a trader business. Just having an investment motive suffices to allow it to deduct investment and management fees. We're on slide 43 here. So again, the profits interest is the key to deflect the income to the C Corp. But we a true partner as a regulation. For those of you who are new to these, you see the parenthetical, like up at the top, it has the parenthetical 2G4L, Roman at 1E. That is the part of my long business structuring materials that covers the topic that we're going over in these slides. So any background you have, of course, you can look at my newsletter, and my newsletter basically has a narrative for what I'm saying today, and then my newsletter does have links to drill down into that. Okay, so what are some of the things you want to consider about when having the family office as a trader business, where you have it being a service partner, so you have a C Corp service partner? What are the things you should think about when you structure the profits interest that goes to the C Corporation? So first of all, the budgeted annual profits need to be reasonable. Now, if you gave it a vested interest, if you gave the C Corp service partner vested interest, that would kind of make it look like it's not quite as reasonable, because they're kind of stuck there forever no matter how they perform. So I would tend not to do a vested interest. What I would rather do is to have an at-will provision that will allow you to fire them. Now, that's on one hand. On the other hand, suppose you have this profits interest, and in year one, the profits are way too big, and they have a huge profits interest that goes to the C Corp. And the family's like, whoa, we didn't mean to deflect all of this. We need to dial that back some, because we're paying too much to the management company. So let's dial it back. So then they dial it back the next year. And then the following year, they say, oh, that didn't get the right amount either. Let's tinker with it some more. And so if you're trying to tinker with it all the time to try to get a particular result, that doesn't really look like it's a true profits interest. That doesn't look like a partner. That looks more like somebody who's getting paid a fee that needs to get adjusted. So it's kind of tough to figure that out. Ultimately, I favor allowing termination of periodic adjustments. Partnership needs a business reason for the investment management company's continued involvement. Why are you continuing to pay all these profits over? But I think that you would basically want a management company with a stable leadership team, invest in the partnership's ongoing success. So I think that's a pretty good business reason. Okay, on to slide 46. Now, you could issue a preferred profits interest to the service partner and maybe try to cap that to make that be a profits interest. And I mean, as a matter of normal partnership income tax, preferred profits interests are totally fine, and they work well. But in a service partner context, with these proposed regs, if these wind up being the law, and they may very well be the position that the IRS takes on audit, the IRS could say, well, you're really reducing the entrepreneurial risk. First of all, you get the first call on all the dollars, so you're almost assured of getting your management fee. And then if there's a cap on the preferred profits interest, the first X dollars, and then after that you get nothing. So in that case, you would be concerned about that, because that looks more like a fee. So I do tend to prefer a straight pro rata percentage of all partnership items. Now that's why I prefer, and that's kind of why my opening salvo when I structure this. But there are all kinds of different tiers of profits that various partnerships allow in the real world, and so you could still have what we call waterfalls, which are various tiers of profits that go in different directions. So you could try to do that, but what I just want to say is that even though you can do that, the more you stray away from a straight pro rata percentage, the more tax risk you're taking. So I'm not saying that there's really anything wrong with doing the waterfalls. I'm just saying that they're a little bit more risky than a straight pro rata percentage. Also, the government is concerned about a service partner being able to manipulate the annual profits to generate a steady fee. So let's suppose you have all these unrealized capital gains out there, and hey, you only need to take out so much each year. So maybe you say, okay, I'm just going to recognize enough capital gains to get me to my target profits, and and then I'll leave the rest kind of on to kind of smooth it out so I look like a, you know. On the other hand, what if you have losses? What if you have unrealized losses? Suppose you have an unrealized loss and you say, hey, I don't want to sell that and take that loss because that's going to reduce my compensation for the year. You know, I'm getting compensated on all the interest and dividends. I'm getting compensated on the capital gains. I just won't take the losses so that I can avoid having my profits interest reduced. So I don't know if the IRS will be concerned about that issue or not, but they certainly expressed concern in the proposed regulations about being able to manipulate the annual profits to generate a steady fee. So you might want to consider capping distributions and saying that if you have unrealized losses, you need to take those into account when you figure out how much can be distributed out. But that does make things more complex. So I'm not saying that you really should always do that. I'm just saying that, you know, you have a lot of different factors that go into this this evaluation, and you would want to make sure that that you've got you know, you kind of weighs the pros and cons between the increased complexity versus doing something that you think will look like it's safer from a tax viewpoint. Okay, so suppose the partnership starts off well and the investment management company receives significant distribution, and then the partnership doesn't do so well, but the management company keeps the money. Well, the IRS says, well, this looks like a fee. Here you got annual payments, and yeah, the next year you didn't get any money when there were losses, but you didn't have to give it back either. Well, if you don't have to give it back, then are you really sustaining the burden of the losses? That's what the IRS is concerned about. The IRS says that looks like a fee. It's not entrepreneurial for you to get the gains and not have to pay back when there are losses. And so there's the idea is that there's a clawback. So if you have income in one year and then loss the next year, then you need to give back some of the income that you got. Now, that's what the proposed regulations are basically saying that they want to see. Now, you are allowed to keep tax distributions, so that's at least some relief there. There's no guidance on when the clawback has to occur. So again, that's just a matter of judgment. When do you require it? Okay, slide 51. Issuing a pure profits interest is a non-taxable event for income tax purposes because the holder will be earning income when each year as the profits are received. So that's kind of the theory. There's if you look at my materials on profits interests in Roman numeral 2, capital M, little 4, I go into issues on the taxability of profits interest. Okay, more caveats. With a C corp, double tax will generally apply when earnings come out sooner or later. So in the long run, C corps are more expensive than pass-through entities. But if the investment management firm is spending its income on providing investment management services, then it might not have much income to distribute. The other concern has to do with whether profit triggers a gift under Code Section 4701. And I have in my materials and in my slide arguments why I try to say that there isn't any So whether there's some risk or not, you need to evaluate that yourself and go through all the different meetings. If a Q-tip trust participates in the investment partnership, then you would be very cautious to make sure that the profits interest going to the family office is not too high. If there's some unreasonable compensation component to it, then have the partners basically somehow made a distribution to the family office out of their own money. And if they have, then you have the Q-tip trust, then you would be concerned about Code Section 2519 triggering an artificial gift there. This way out of proportion compared to what actually went over. Okay, the investment partnership has to account for built-in gain or loss, not only when assets are contributed to the partnership, but also when partners come and go. And there's some disguised sale rules that apply when you have contributions before or after a distribution of property, or when you have a contribution of property within 2 years before or after distribution of cash. So you have to kind of go through it, just address those issues. If the corporation provides personal services that do not relate to managing investments, be sure to charge them, because failing to charge for them can have a double whammy. You don't get to deduct expenses, and the shareholder will deem to have received a taxable dividend. So be very careful that any family office will charge for the expenses if it's a C Corp. Okay. I have a question if I've ever seen a family office structured as an LLC, electing S status that's wholly owned by a non-grantor trust. And I mean, if you're in a pass-through, then you have all those issues I was talking about before. And it doesn't matter whether it's a grantor trust or a non-grantor trust, you still have the same issues. So, I'm still kind of generally all in to go for C Corp. It could be an LLC that elects C Corp status. If you're not talking about having the investment expenses, and you're just talking about a family office that's just providing personal services, and you're not trying to do any of these things with the investment management expenses, then I'm just kind of, I don't really have a particular view on that. Okay. So that answers that question. Failed to spousal grantor trust. So I'm going to talk about what it is. What is it? Well, what is a spousal grantor trust? So it's an irrevocable trust that one spouse creates for another, just kind of like it's what it says. The grantor trust rules say that when you have a spouse that's a beneficiary of the trust, the grantor is going to pretty much automatically be the deemed owner of that trust. Now, I put in a swap power just to kind of help nail down the grantor trust treatment so that I can kind of be a little bit more confident on what I'm doing with that. But the bottom line is that you're going to have, whenever you have the spouse be the beneficiary, you're looking at the grantor being the deemed owner of the trust. We're going to talk about funding this trust, grantor trust issues, other income tax issues, and transfer tax issues. So client spouse establishes a irrevocable trust for the client, and then the client sells assets to the trust. So the beneficiary sells assets to the trust. Now, that is considered to be a deemed sale of the assets to the trust, and we're going to talk about the consequences of that. But there's going to be no capital gain on that sale. All right, slide 58. A lot of times when you have a beneficiary grantor trust, it's going to be thinly funded. You're going to put in no more than $5,000 initially. So there's some concern about, you have this centrally funded trust and you're doing all these transactions with it. Is the IRS going to respect that centrally funded trust? And there's a lot of people who kind of come out all over the place on the level of risk for that and what you might do to ameliorate the risk and how much those steps to ameliorate risk actually do help. But if you have the spousal grantor trust, so it's going to be deemed owned by the grantor spouse, and you're doing the sale to it, and you're not going to have any income tax, no capital gain tax on the sale. So you avoid capital gain tax, and you can have this trust be funded very, very well. You could, use up part or all of your lifetime gift exemption to fund the trust. Put in millions of dollars into it. So you can have a well-funded trust, and then let the beneficiary, who's a business owner, sell the business to the trust. Be careful when making gifts to the trust. If the beneficiary made a gift to the grantor, and the grantor turns around and uses that same gift to fund that trust, then Code Section 2038 might come back to bite you. And so you want to do your best to avoid the donor spouse using property that the beneficiary spouse gives to the donor. Just as a sale to a beneficiary deemed owned trust, the beneficiary could be a trustee authorized to make distributions for his or her support. A trustee not appointed by the beneficiary or a trustee who's independent should be able to make distributions for the beneficiary's welfare. And we especially want to build in welfare, best interest, whatever you want to call it. And the beneficiary would take this distribution, and then when they file a joint return with the grantor, the beneficiary could use that money to pay the grantor's taxes. They're just on a joint return. There's no differentiation between my taxes and yours. So that's kind of the idea. You don't want to kind of lay out a paper trail that says that's our plan, because you don't want to have have the grantor be an indirect beneficiary of the trust. So it's a touchy thing. You don't want to document an intent. You don't want to actually show an intent. But the idea is that is available if you get into trouble with the tax issues. Okay. So the spousal grantor has no way to turn off the grantor trust status. So let's suppose that a husband creates a trust for a wife, and then wife sells her business interest to that trust. So now, wife is the beneficial owner of this business, but husband is being taxed on all of this income. Then they get divorced. Well, even though they get divorced, it's going to be fully a grantor trust. Even though it's an ex-spouse who's the beneficiary, the divorce does not cut off the grantor trust treatment. This was a change made by the 2017 tax reform, and I'm less than thrilled with that change, but you got to deal with it. So you might want to consider having a grantor, a tax reimbursement provision for that, and for that reason, you may want to do the trust in a self-settled spendthrift trust state, like my home state of Missouri, respect self-settled spendthrift trust. You may want to do it in some states. Don't allow self-settled spendthrift trust generally, but they will allow an income tax reimbursement clause. And so you look at both ADAPT states and those that have the the income tax reimbursement clause. Okay, slide 61. The selling spouse does not recognize gain on the sale of property, and because Code Section 1041 protects it. And if you have a sale to an irrevocable grantor trust, where the grantor sells to the trust, we don't really know what happens when the grantor dies. Does somehow there be some kind of a deemed gain when on the grantor's death? Because there was no deemed note outstanding before death for income tax purposes, but for income tax purposes after death, there is a note that's outstanding. So has there been a deemed sale that occurs? And we don't know the answer to that. And there'll be some people say, oh yeah, there's no deemed gain on sale. There's all kinds of authority out there for no deemed gain on sale. And that's their opinion. So I profess uncertainty on the topic, and it all depends on whether I'm planning mode or compliance mode, and also what's the best interest for the client as to whether to recognize a gain on sale. Anyway, but we know that with the sale to a spousal grantor trust, that there's no gain on sale because Code Section 1041 protects it. And so when the grantor spouse dies while the note is outstanding, you've already had your event that issued the note. So it's not like the note was disregarded like it was in a grantor trust. The note is given income tax existence. So when the grantor spouse dies, that's not going to trigger all of a sudden a gain on the sale. Okay, interest payments will be taxable to the selling spouse and may or may not be deductible by the grantor spouse, depending on whether the nature of what is purchased. I do include in my materials a reference to an argument that was made at 2020 Heckerling that you might make stated. You might put in higher principal but not stated interest, and I'm just going to refer you to where my materials discuss that issue. That wouldn't be my preference, but I'm not going to argue about it right now. I just refer that to you. You can make your own decision. Regarding the statute of limitations on the sale of the trust, so for gift tax purposes, the statute of limitations runs if you have a completed transfer. But the regulations don't say what a completed transfer is. So let's think about what happens when in my example where the husband created the trust for the wife and then she sold her business to the trust for her benefit. Now, wife is a beneficiary. Wife has the power of appointment at her death. If wife sells and the IRS determines that not enough was paid back to wife, the wife has made a gift because of the bargain sale. So is that a completed gift? Well, no, it isn't, because the spouse has distributions during, the beneficiary spouse has distributions during life and has a power of appointment. So that's a wholly incomplete gift. So that's an incomplete gift. And if it's an incomplete gift, then will it qualify as a, quote, completed transfer, unquote, for purposes of the gift tax return? Well, I don't know for sure. But there are a lot of people who are concerned about it. And so what I'll do is I'll tend to do a formula sale, but I won't give a power appointment over 10% of it. So the beneficiary spouse will not have a power appointment over 10% of it. So if there is a gift, then 10% of it will be of a partially complete. That will be a completed gift, and so you will have a completed transfer. So that's, I didn't make this up. I've heard from several other smart lawyers who do something like that. So I suggest you think about that too when you do that. Okay, so compare this to a sale to an irrevocable grantor trust where the settlor is the seller. When you have an irrevocable grantor trust like that, so the grantor can turn off the grantor trust powers. So if you design the trust in a way that lets you turn it off, then certainly you can. And often I just use the swap power and I turn off the swap power, and then it's no longer a grantor trust. So it's relatively easy to control, and then it's not quite as scary. You can give a power of appointment to the primary beneficiary for 100% and still run the statute of limitations. You could even have your spouse be the beneficiary. So your spouse, you do a trust for the spouse and the kids, and the spouse is beneficiary, and then the grantor sells to that trust. So there's no incomplete gift argument there because the grantor doesn't have it. The grantor, who's the seller, doesn't have an interest in the trust, no beneficial interest in the trust. So you don't have that. You don't have that issue. So you have a power of appointment for 100%. Still run the gift tax statute of limitations. Whereas with the spousal grantor trust, I will give a power of appointment only for 90%. Okay, how about a sale to a beneficiary grantor trust? We have one of these thinly funded deals, and then you do the sale. So generally, you can't turn off the grantor trust powers for that as well. So the beneficiary is going to always be the deemed owner. There is a way, I think, that you can turn it off during the settler's life. That's in my details of the same issue regarding the power of appointment. I would give the beneficiary power of appointment over only 90% of the trust instead of 100% of the trust, because I want to run the statute of limitations when the beneficiary reports the sale on the gift tax return. Now, the beneficiary grantor trust tends to have minimal funding, so that might make the sale more risky for estate tax and for other purposes. Okay, so that's my main topic. I'm going to go and answer some questions here. So I'm going to slide 59 here. And I got a question from an outstanding lawyer who asks, why not just authorize the trustee to pay or reimburse the grantor's income taxes in the grantor trust? Simpler than my distribution for welfare approach. So the question is, suppose we have we're in one of these states that's not a self-settled spendthrift trust. I'm sorry. We're in a state that does allow domestic asset protection trust, self-settled spendthrift trust, or allows income tax reimbursement clauses without making the trust subjected to the grantor's creditors. So the grantor is getting these income tax reimbursements, so the grantor is getting a benefit from the trust, and just because the grantor has this benefit doesn't mean the creditors can go after it under state law. And my concern here is that when you look at the tax law underlying that income tax reimbursement clause, you look at what Revenue Ruling 2004-64, Revenue Ruling 2004-64. And what that Revenue Ruling says is that if you have a self-settled spendthrift trust, you won't have 2036 inclusion if the creditors don't have access to it, and there's no implied implied understanding that the grantor will actually receive the distributions. So the problem with having the direct income tax reimbursement is that if you consistently make distributions to reimburse the grantor's income taxes, then the IRS will say that you have an understanding that the grantor will be receiving these reimbursements. You violated the rule of Revenue Ruling 2004-64, and now you have 2036 inclusion. On the other hand, if you make the distribution to the spouse, then you don't have any direct distribution going to the grantor, and so you wouldn't have violated that revenue ruling. Now, the IRS might come back and say, hey, it was all understood, then not only would the spouse get that distribution, but the grantor would benefit from that distribution as well by paying the taxes. And so there's a possibility the IRS might make that argument. But the IRS has a higher burden of proof for that if you had a consistent pattern of distributions directly to the grantor. Okay, so I have another one by another outstanding lawyer. Do you see any considerations in comparing sale to spousal grantor trust versus sale to a spousal grantor trust created by the seller spouse? So the issue would be that we have the sale to, so we have the grantor selling for the trust for the spouse versus the spouse selling to the trust for the spouse. And I think that that those are really two totally different paradigms. And just like any other sale to irrevocable grantor trust, where the grantor sells to the trust, I think you have that set of issues. But I think those issues are less than the spouse selling to the spousal trust. But I am totally fine with saying a sale to a spousal grantor trust by the grantor, a sale by the grantor of the spousal grantor trust. I would treat that the same as any other sale to an irrevocable grantor trust without any extra layer of risk, with the caveat I just mentioned about the tax distribution issue. Okay. Do I worry, another question, do I worry about whether Revenue Ruling 78-195 is enough authority for corporations to get 162 on investment expenses? So what this question is, that revenue ruling that person cited, that's the revenue ruling that says corporations can deduct investment expenses. Now, that wasn't marketable securities. It was actually land held for investment, and so it's possible the IRS could distinguish it, but I feel very confident that that's enough authority for it. I think that land was not even as much activity as managing a marketable securities portfolio. So I am confident in that revenue ruling. Another question: can you handle the income tax issue for a post-divorce spousal grantor trust in a marital settlement or a post-nuptial? So I mentioned that the grantor trust treatment will never turn off, even after divorce, when you have a spousal grantor trust. And the question is, well, what if you've got these distributions that would go to the now ex-spouse? Can the ex-spouse then be compelled to turn over money to the grantor as part of the divorce decree, or et cetera? Then then that way you can get the taxes reimbursed. And I think that could be done with a divorce decree. And in fact, one of the most brilliant lawyers in the country has suggested doing that. And so I definitely agree with having that in a divorce decree. A post-nuptial agreement was the other part of the question. I'm not comfortable with doing it up front in a post-nuptial at the same time the trust is created. But perhaps, several years down the road when there's no way to do a step transaction, then I might be comfortable with that. Well, we've come to the witching hour, and I thank all of you for your questions and your attention. And please complete and submit the survey that will display at the conclusion of the webinar. I got to do my last slide here. So my last slide, I just want to point out, that's the February 12th, 2019. That's a typo. That's 2020 webinar that I did. So you're anybody with fiduciary income tax returns just still working on, that's great to look at, or with general fiduciary income tax questions. Also encourage you to subscribe to the various resources we have there. And I look forward to hopefully talking to most of you on July 28th. Again, thanks so much for participating, and please complete and submit the survey that will display at the conclusion of the webinar. Thank you very much. See you next time.